Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Rob Beardsley. Thanks for being on the show, Rob.
Thank you.
Yeah, it was a pleasure to meet Rob in Denver a week or two ago, and I've heard a lot about Rob before we actually met, and just his expertise in underwriting specifically, and it's just such a crucial area to have a great understanding in this business that we call syndication, and whether you're active or passive. It's important that you understand the underwriting, or at least you know what questions to ask and what you should be looking for. And he's going to help us, to understand that today. But he has a background in business and computer science from Carnegie Mellon University. He leads the underwriting and structuring function for Lone Star Capital Group. Prior to co-founding Lone Star, Rob had extensive real estate experience through his family and numerous real estate businesses, including development, construction, sales, and investment. Rob also actively publishes articles and white papers about real estate, capital markets, family strategy, multifamily strategy, and deal structuring. So, Rob, thanks again for being on the show. Again, it's a pleasure to meet you the other weekend, and give the listeners a little more about a few more details about your background, and let's jump into the underwriting.
Sure. Yeah. Thanks for the great intro. So a little bit more about me and my background. I really started in the syndication business about 2 years ago and took to the underwriting, like you mentioned, the numbers aspect and what drives a deal. And, right now we're in the middle of, some say we're towards the end of, which I agree with, a strong bull market and multifamily valuation, as well as income growth. And so that has made underwriting less important because people have been able to buy deals, and whatever mistakes that they may have made in their underwriting was just pretty much washed away by this very strong market. So, and then to add on to that, at the end of the day, when you are in the syndication business, you are investing in people and not deals. However, the deals are still very important, and the numbers driving the deals is what really makes a viable investment.
I like that a lot. You're talking about investing in people and not the deals, because the operator is key, right? I mean, no matter, right. It could be the best deal you've ever seen, but if the operator has no clue or isn't going to perform, then pretty soon it's going to be the worst deal you've ever seen.
Yeah, exactly. And, so you can pretty much simplify it down to, what's the deal, what's the market, and who's the operator. And you can partially consider underwriting basically honing in on the details of the deal itself and the sub-market and the market. Obviously, underwriting is, you can't really put numbers on trust and people, but underwriting takes care of it, half the page.
I was writing that down. You can't put numbers on trust and people. I like that. You didn't mention, though, and I was just asked this not too long ago, so I wanted to clarify in case listeners didn't understand. Even the term, like you said, end of a bull market. Well, if somebody says bull market, what does that mean?
Well, typically a bull market's referring to the stock market, stocks going up, bull market, stocks going down, bear market. But even more specifically for multifamily, since the Great Recession, we've seen a huge compression in cap rates, which is how multifamily is valued. So even if the income of the property doesn't change at all, you bought it, sat on it, you collected the same rents, you had the same expenses, but your cap rate compressed because of various factors such as interest rates or investor demand, your property could have doubled in value. And people really realistically saw that happen to their properties without renovating, without improving management. But that's not the only thing that happened. The other thing that happened is we're having a very strong demographic tailwind of increased renter demand, household growth, income growth. And so that has led to not only have cap rates compressed, which, buoyed valuations, but also NOI growth, net operating income has grown significantly over the last 10 years, consistently year over year. So those two things resulted in a huge drive in total valuation.
Nice. So I appreciate that. But let's get into the underwriting and just some key fundamentals that every listener that's getting into this space needs to know. Get us started.
Sure. So I think we'll start from the passive investor LP perspective, and then work our way up to approaching underwriting from a GP or sponsor perspective. So starting as a passive investor, being at least knowing the key factors or some of the key indicators that drive the underwriting is helpful when evaluating a deal. I see a lot of investors making their investment decisions solely based on who the sponsor is, which is very important, but then just reading over their glossy offering memorandum, and that's pretty much it for them. So I think there should be an added layer of due diligence, which is digging into the numbers, and then not only just accepting those numbers at face value, but actually assessing the validity or the viability of those numbers. So, starting with the simplest measures are cap rate. And it's kind of cliche because that's the first thing you hear and the most talked about number. However, a cap rate's not a cap rate. There's a million different ways to value a property's income, and thus it can be misconstrued to appear better. So some of the ways that I would encourage investors looking into a deal's historical cap rate is, first, I would make sure that the numbers you're looking at are truly historical and nothing is being projected out into the future, that these numbers actually happened in the past. And going from there, it's most likely necessary to tax adjust the historical financials, because typically when you purchase property, the taxes will be reassessed, especially if you're buying value add and putting CapEx dollars into the property, because the assessor's office is going to see that. They're going to see that you're going to be driving income through raising rents and renovations, and they're going to want to get their piece as well. So, look to a larger assessment at that point. So it's helpful.
I wanted to ask you though, as far as and we're talking about as a passive investor, some things to look at for the underwriting, but, making sure the numbers, look right or truly historical. How do I know that as a passive investor? What are some other things I need to be looking at or asking? And maybe that's even intimidating to me as a passive investor. I've got this other business I'm an expert in, but I'm wanting to invest, in some real estate. How do I know how to do that?
Right, and so that goes back to who you're investing with, and so hopefully your sponsor is doing a good job of reporting the numbers and showing you a simple breakdown. Here's our T12 analysis, or here's the historical P&L, and then here's our year one pro forma P&L, and then year 2, year 3, year 4, but making a clear distinction of, okay, here's the numbers as they are, and then here's our plan to take them there, or take them where we want to go. Because it's not uncommon these days, as people are pushing the numbers to make deals still look similarly attractive as they have been 5 years ago, with how the market's performed amazingly. It's not uncommon to see sponsors have a 20, 30, 40% increase in their income from historical to year one. And, that is definitely needs to be substantiated, to say the least. So I guess just starting with asking if it's unclear as to what the cap rate or what the financials are referring to. But if you really want to get to the core of it, you should just ask for the due diligence files that the sponsors themselves are using to underwrite and put together the business plan. And that would be the seller's T12 and the seller's rent roll.
Okay. So now the tax adjusted financials, you were talking about that, and we'll keep going.
Right. So that's kind of the first thing I do off the bat, because cap rates can look decent a lot of the time before you adjust for taxes, especially for older properties that have a very low assessment. You can be looking at a 6.5 cap, and it's still a value add deal. However, if property taxes, let's say, are $200,000, but you can reasonably assume a 25% increase to the taxes, you should factor that into your cap rate to see how much income are you actually purchasing for your dollars. And then the next adjustment I like to do is management adjusted. So there's a million different ways to manage a property, and there's a million different compensation structures. Some owners don't have a management fee included in their financials at all, and some have a very bloated fee structure. So I'd like to, first of all, identify all the items in the financials that relate to a management fee, and then basically throw them all out and then plug in what it would cost us to manage it, and then put that into the historical financials. So now we've adjusted the historical in-place numbers with what we think taxes will be moving forward, as well as the cost for us to manage. We don't care how much it costs them, how much does it cost us? And now we've pretty much figured out the true level of income we're purchasing for our, how much income I'm buying per dollar.
Nice. So what's my income per dollar? No, I like that. Go ahead.
Cool. So that we kind of went a little deep there, especially for just a passive investor, but that's a great place to start. And then, looking over another group's underwriting from a passive investor's perspective, just quickly, you'd want to see, okay, what's the year-over-year change in NOI from T12 to year one to year 2, 3, 4, 5, especially if you're looking at a 10-year deal where the sponsor's underwritten on a 10-year timeline. I would be very cautious if I see that the sponsorship is showing that income is still going to be increasing year over year by 3 to 5%, even out in 6, 7, 8, year 9 and 10, because that's just a lot of years of assumed more positive growth. So, keep an eye out for
what would be a safe range that we should be looking for there as a passive investor, where you would say, okay, this looks like a conservative deal, and maybe underwritten conservatively enough that I feel comfortable investing, as far as the growth that should be expected. I know the location, the market, all those things play into that, but just as a passive investor, what should I be looking for?
Right. Yeah. So that's a good point. I think 2% year-over-year growth after the business plan has been achieved. So there's two forms of growth that you have to model out into a value add deal, which is first the growth that you're affecting on the property through forced appreciation, spending money, improving management in order to increase rents and decrease expenses. So that's the usually occurs in years 1, 2, and potentially 3. But after that, property should stabilize out, and there shouldn't really be any outsized growth embedded into the underwriting. While it may happen, some of these very fast growing markets may continue to grow quickly at 6%, 7% rent growth per year. But all these markets that are currently experiencing that level of growth, nobody was underwriting 5 years ago, oh yeah, we're going to have 7% rent growth here. Nobody knew it. Maybe they thought it was a good market, but they still probably underwrote conservatively to a 2 or 2.5% rent growth and a 15% IRR, but then the market took off and they have a bonanza on their hands. So you don't want a sponsor relying on another terrific run of rents and cap rate compression to achieve their return. So I would say after the business plan has been achieved, look for a stabilized growth in income of 2%.
I like that. 2% after the business plan's been achieved, and that you're going to consider that conservative underwriting.
Right.
Okay.
Right. And then the next piece, we've covered in-place numbers, growth, and now the exit. So, and we're kind of starting from most difficult to misconstrue most difficult to misconstrue to least difficult. So, it's pretty hard to say my year one numbers are going to look this way because they're grounded by the current numbers. But the further away you get from the current numbers, there's more that you can argue and play with and say, well, give us 5 years and the property will be in this sort of shape with these sort of rents. And then similarly, your exit is very disputable, right? You could say, well, I think the market will be better than now, or it will be, prices will soften. And so the way that you manipulate, or I shouldn't say manipulate, but that you control the exit price is through the exit cap rate. And so typically you hear a lot of people say, we model a conservative exit of 50 or 100 basis points above our entry cap rate. So that makes a lot of sense, because if today you have to pay, let's say, a 5 cap for the product you're buying, theoretically the market should have to be in a reasonably worse place to sell that same property at a 6 cap. So that is conservative underwriting. However, what a lot of people are missing is, let's say, for example, I'm buying a 100-unit building, but it's only 50% occupied. And because of that low occupancy, I'm paying a 3 cap. So if it were fully occupied, it would be a 6 cap. But I'm paying a 3 cap because I'm buying less income and I'm essentially paying more money for the opportunity to lease that building up. Well, it would be extremely aggressive and simply incorrect for me to assume I can exit that deal at a 4 cap because I bought it for a 3, I go up 100 basis points and I exit at a 4 because the market is a 6 for that product when it's stabilized. So you have to make sure that you're modeling upon sale what actually the, above 50 to 100 basis points above what the current market cap rate is for that sort of product, not value added to stable, but stable to stable.
I hear some people say, "Oh, I don't really care about cap rate," especially when I buy a property. And what are your thoughts about that?
Yeah, I mean, there's something to be said about that because it's not the end all be all, and not everybody is looking for yield. Some people are comfortable with buying a property with a lower cap rate for the embedded growth. So if you look at New York City, Silicon Valley, Los Angeles, if you look at key markets, core markets like that, they have the lowest cap rates. And that's because as a consensus in the investment community, people believe that those markets will grow faster and be more resistant to the negative effects of a downturn. And that's why they're willing to pay that premium, essentially a lower cap rate for those markets. However, during your ownership period, you're going to get much lower cash flows than otherwise available in more reasonably priced markets. So, while I don't want to say cap rates don't matter, it's just you certainly don't need to buy a certain cap rate to make a deal a good deal. A deal can be a good deal at any cap rate. It just depends on the business plan and what you're looking for, whether you're looking for to get your return via yield or for capital appreciation.
No, I like that. I like your answer. I mean, the cap rate doesn't mean everything, or it's not the buy all, take all, whatever, they say. But no, and then elaborate a little bit on, you say 50 basis points to 100 basis points. I know, I know that's a term we use in the industry a lot, or, we're talking about underwriting, but somebody that's just learning this, what does that mean?
Yeah, so 100 basis points is equivalent to 1%. So when we say 50 basis points, it's 0.5%. But when we're discussing certain metrics, the number needs to be so precise that it's easier to refer to basis points. You're talking about, 10 basis points is just 0.1%.
Who is Vinny Smile Chopra? Came to the U.S. from India with $7 in his pocket, and today he has created a portfolio of over $200 million in commercial real estate. He's a CEO of 5 companies, acquiring and managing diverse multifamily portfolio of 3,500 units, and his team self-manage all the assets. Vinny has walked the walk with over 26 successful syndications during multiple economic cycles, including downturns over 12 years. He has built a very extensive educational academy to teach and mentor investors. Vinny, tell us about this multifamily syndication academy.
Thank you, Whitney. Thank you so much. I'm really proud to really talk to everybody about this extensive multifamily academy that teaches new and sophisticated investors how to use other people's money through syndications. That has been my world, to buy apartments from 50 units to 500 units, and how to select emerging markets, how to do deal analyzing, investor education, other people money, syndication blueprints. Everything I have learned, I teach in this academy, and over 500 lectures, and also how to manage the assets also, and along with lots of great templates and PowerPoints, everything. And I personally also mastermind coach all my students every Wednesday. So to reach me, Whitney, all the students have to, or investors have to, just text the word learn, 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 to 474747, or call my team at 925-766-3518.
Right. Okay. No, I like that. I appreciate that. And then, as far as just talking to your investors and things like that, how often are you using terms like that when, talking to somebody that's just looking to invest in a deal?
Yeah, well, as you can tell, it's kind of hard for me to filter myself. I get into it and
That's
get
good.
excited and start saying all the terms. But yeah, I pretty much just speak this way, and as I would to a peer investor, and I encourage people to stop me and ask questions because I'm sure they're I hope they're asking questions.
Yeah. No, it's good. It's good stuff. So we talked about the exit plan, the exit cap rate, and, keep going.
Okay, so we've almost made it. I mean, we started at the where are we in place numbers, what's the projected growth, and then what are the assumptions upon exit, and that really are the three foundations of conservative underwriting. Because at the end of the day, you can tweak a deal by saying, well, if we just assume we'll sell it for a little bit more, then the numbers will look all that much better. Or if we just assume a little bit more growth in years 3, 4, and 5, it'll sell at a higher price, as well as having higher income during those years, because the sales price is calculated based on the final year's net operating income. So when you manipulate income, not only are you assuming more income coming in during ownership, but you're also assuming a higher exit price because of that increased income. But I mean, I would say we pretty much made it from there. And then if there is a strong story that involves rental increases, as a passive investor, it would make sense to kind of review the cost set, and hopefully you trust your sponsor to provide you honest, transparent rent comps, and you can see, okay, well, there's a community down the street that's achieving $1.25 rents. We're only at $1.10. They have a $5,000 renovation in place. If we do that, it makes sense that we can achieve that as well. So, rent comps is a feasibility test to the business plan.
Nice. So what about, moving into the sponsor side, what maybe some other things. So let's dig into the weeds a little more as far as the underwriting, and helping somebody that's maybe looking at a deal now or underwriting something now they're looking to pursue through syndication.
Yeah. So moving to the GP side, and I'll take a step back and look at it from a perspective, you're looking at a deal, you're looking to put in an offer or, formulate a business plan. And there's so many ways you can go. You can pursue a deal with permanent financing, bridge debt. You can, tweak with your GP performance splits as far as your fees and your promote. There's so many ways that you can structure a deal and to hopefully make it a better deal for all parties involved. But, as far as a GP, I think it's important to, when you're looking at a deal, the debt is a major component of the deal, and it's worthwhile to evaluating your options when it comes to debt. And typically your options are the agencies, Fannie Mae, Freddie Mac, and then the whole bridge world, and then there's also HUD. So I would encourage everyone to look at all the options and just get educated on the different ways that they could potentially match up well with a given business plan. And then, you might have seen my most recent article about the case for floating rate debt. I think floating rate debt is a very interesting product right now, since there's I think now, as of today, a 20% probability that the Fed will lower rates this year. So, last year there was a huge bias to the upside, or to the increase in interest rates. So everybody wanted fixed rate debt. But a lot of people overlook the steep prepayment penalties associated with fixed rate debt, because people were looking to lock in the lowest fixed rates possible for the longest term possible, because they were scared of one, a recession, and two, for rates going through the roof. So in order to get the lowest fixed rate, you'd have to accept a really draconian prepayment penalty, which would be yield maintenance. So meanwhile, for floating rate debt, it's just a 1% exit fee. It's pretty much the cheapest exit you can get. And it still offers if you believe historical numbers, the benefits of an overall lower cost of debt payment for floating rate debt. So anyway, that's just some of the more complex things to look at as far as underwriting. Should you use fixed rate debt, floating rate debt? Well, that depends on, where do you think the risk lies in your deal? How long do you plan on holding the property? Also, there's a lot of ways to balance business plan versus investor expectations. And so maybe it's easier to raise capital with a fixed rate loan, because you can pitch it to investors. Hey, we're buying a fixed rate. We're buying a property with a long-term fixed rate debt. This is safe. This is conservative. Even though, which I'll say, in my opinion, I think the floating rate option may be better right now.
You're going to have to be able to explain that to an investor, right? And why? I mean, and you did just then. I mean, I really liked that. And it's obvious you have to understand the debt. And so you have to understand your exit plan, right? So you know what type of debt you should obtain.
Right. Absolutely. And, that just goes into the underwriting. If you are going to use a long-term fixed rate loan product with a yield maintenance prepayment penalty, how are you going to model that? Are you going to, because typically most deals are underwritten on a 5-year term, but if you're doing 10-year debt with yield maintenance, with 5 years, halfway into the loan, that could be, I'm not sure, 6% equivalent prepayment penalty, which really would preclude a free and clear sale. It would force you to sell as an assumption. And, assumptions aren't the end of the world, but if you're in underwriting, is assuming a large increase in your purchase price, in your sales price. Now you're selling your property and your loan to the next buyer, but your buyer isn't interested in your loan because you've sold it the price at a much higher level. So the loan is a much lower loan to value ratio. And what that means, the borrower or the next buyer is going to pursue a supplemental loan, and supplemental loans are typically a bit more expensive and not as flexible. So it's important to assess, okay, what is my exit strategy and how viable is that? And maybe I should discount my exit cap, meaning I should discount my projected purchase price to more realistically accommodate an assumption sale.
So we're running close on time, but I want to get to a couple more points, on the active GP side, after financing. Sure.
Yeah, let's try to get a couple more points in. So in terms of GP structure, this is more of a personal question or answered internally for GPs, but what kind of fee structure would you like to charge? And I think half the conversation is, well, we need to make sure that our interests are aligned with our LPs, our passive investors, think that our fee structure is reasonable and incentivizes us to do the best job possible for them. And then also, at the end of the day, we're in this business to make money. So how can we put into a fee structure in place that, in our opinion, benefits the investors while still make sure we get paid? And so I think there's, a discussion there of, we need the right balance of fees and then performance-based fees. So a lot of GPs are looking at putting prefs on their deals or not having a preferred return. And the preferred return is just when the LPs or the passive investors, they get not necessarily a guaranteed, but the first 8% of the profits coming out of the property every year are owed to the investors. And then thereafter, once that hurdle is met on an accrued basis, then the GPs get to get a piece of those ongoing profits. And so there's arguments to be made both ways. And I mean, I'll just quickly run through a lot of sponsors are removing the pref because, number one, it's just so difficult to hit these days. Getting a property to realistically achieve 8% cash on cash in year one of a value add plan is very tough. And whether you're doing a bridge loan or permanent debt. So a lot of sponsors are saying, well, hey, it's so hard for us to hit our pref. We're going to get behind in year one because we're only going to return 5. And then we'll never catch up and we'll never make money. So let's just not have a pref. And they're selling not having a pref by saying, well, actually a pref doesn't align our interests, because what it incentivizes us to do is to take on more leverage, take on more risk, and try to really achieve lots of cash flow. Or it incentivizes us to sell because we know we'll never catch up to the pref. So we'll sell a perfectly good asset just so that we can get a piece of the capital gain. And all those things are true. However, if you look at the split on a mathematical basis, saying if you have normally an 8% pref with a 70-30 split on the back in favor of investors versus an 80-20 straight split, the 80-20 straight split is extremely expensive. Investors right now looking to place their capital with sponsors should really insist on a pref, not only because it's the more fair way, but really these days with cash on cash being so low, they're going to do so well because they're going to get pretty much all of the cash flow. Most of the deals we're doing, we're anticipating giving 95% of the cash flow to investors, just because we frankly are having a hard time finding deals that will adequately hit our pref.
I appreciate you bringing that up as far as they should insist on a preferred return, and how some teams are not even are doing a preferred return. And I would ask this too, because it's a question I've heard numerous people talk about in the industry. I'd love to have your opinion as far as raising the capital ahead of time to meet the preferred return. Let's say in year one, when let's say we're expecting quite a bit of vacancy, and obviously there won't be the cash flow there to make the 8% preferred return, or So what about raising that capital ahead of time?
So I think there's a couple ways you can go about it, and I think if you're upfront with investors about the mechanism with which you are delivering that preferred return, to kind of make the joke of, okay, well, so you're buying a 5 cap, your cost of debt is a 5 cap. So you have no positive arbitrage between your income and your debt. Yet in year one, you have an 8% preferred return that you're meeting. It doesn't make sense. So if you're upfront with your investors as to how you're magically meeting your preferred return, and they're okay with it, then by all means. But in my opinion, I think it does a couple things that are negative for the deal. So number one, by having to raise that additional cash, it kind of weighs down the deal. It increases the nominal pref amount, and it actually will lower the IRR because there's more money that the profits have to be distributed to. And the other thing is, and this is really why GPs do it, is by quickly meeting the pref via simply just raised cash distributions. Now the GPs have met the pref, and now they can start collecting a percentage of the cash flow. So they've really artificially met the pref, and now they're able to participate in the promote or the cash on cash performance of the property via that mechanism. And so, while other people are struggling, let's say 5% in year one, like I mentioned earlier, and then in year two, maybe they've done a good job and now they're at 8. Well, they still owe that 3% from last year. And then year 3, they do even better. They're at 10. Well, they still owe 1% from year 1. And so they're not going to get paid until maybe year 4 based on the promote split or the performance incentive. So that can seem extremely unattractive from a GP's perspective, but from an LP, I mean, that's great. So I would really, as a passive investor, rather not see raised capital be distributed to meet the pref.
Well, unfortunately, we are almost out of time. We're over time a little bit now, Rob, and there's so many more questions I want to ask you, and we hope to have you back on and us discuss this a little more in detail on a few other topics around underwriting and other things. But tell the listeners how you learned how to underwrite deals and become so educated in this topic, and then also tell them how they can get in touch with you.
Yeah, absolutely. So like I said, when I first got into the business, this is where I gravitated to. And, so I started out just Googling all the cash flow models, the underwriting models. I said, well, I need to underwrite deals, so let me find myself a model. And then my dad, and at the time we were working on joining the business together, he said, nope, you're going to build your own. And I said, why? That's such a waste of time. I could just download a perfectly good one. Why recreate the wheel? And he said, nope, you're going to build one and it'll be better than all the rest. And so I can't say it's better than all the rest, but I will say that I've spent over 100 hours building it and iterating it. And through that process of building my own model, I've just learned so much. And now I have a finished product with which I can, live and breathe with and really trust that I'm performing good valuation. And then just other learning is just reading all the books and kind of, looking at crash courses for financial modeling and taking some pages from the private equity, discounted cash flow valuation practices.
Yeah, and I would say by building that model, I mean, you understand where the numbers are coming from better than a lot of people. I mean, because you had to build it. You had to tell it to take it from here and put it there and how much and all those things. So how do the listeners learn more about you and your company?
Sure. So you can visit our website at lonestarcapgroup.com, and you can email me at rob@lonestarcapgroup.com. Shoot me an email if you'd like a free copy of my underwriting model or have any further questions. I'm happy to answer.
Wow. Giving out his underwriting that he spent hundreds of hours on. That's a big gift. And I hope the listeners will reach out to him, and I'm going to reach out to him myself. I can get a copy of it. So anyway, Rob, thank you so much for your time and your expertise in providing to underwriting and just such an important topic. I hope the listeners will reach out to you. I also hope the listeners will go to LifeBridge Capital and connect with me, where you can also see the podcast and you can search guests and different topics and learn the topics that you need to know right away. So, and also go to the Facebook group, the Real Estate Syndication Show, so we can all learn from experts like Rob and grow our business together. We'll talk to each of you tomorrow.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.